Hey Activision Blizzard hardcore gamers, welcome back to Future Wealth. Today we're going to be looking into the financial statements and the intrinsic value and if it's a good buy or not, to see if we're going to put some money into this. All these good games that they come out with all through these years, possibly it's a good time to put some money back into the company right now. I don't know, it made some headlines today, so let's see what's going on. Stay with me. Alright guys, so today we have the income statement, the balance sheet, and the cash flow, and of course the intrinsic value of what I have in my infamous spreadsheet. Now we're going to go through each section and I'll detail out the information that I have before you based on the spreadsheet that I put together that I've used for other stocks that I analyze to see if I want to get myself into a position of purchasing it to add into my portfolio. The income statement we're going to look at here right now, the current trading price, the stock price of Activision is $91.91, and they do pay a dividend, which is not a whole lot. It's 0.5%. It's not a lot that you would consider into buying into, but they have been paying their dividends, so that's something to actually take in consideration as well. Now if you look at their income statement, their net income, their revenue, their gross profit, now their gross margin, so I just want to go over these columns that I have highlighted in green, red, and yellow. I've actually added the yellow, which is a new feature for myself. So the green means anything above 40% in the gross margin mark. So much money in there that it's above the 40%, which is good. And you can see each year they have been producing all the way up to the trailing 12 months. So that's some numbers that you can take in consideration, that their income, their net income, their revenue, they're doing pretty well, Activision, right as we speak of today. And of course, the net margin is after everything that they spend on and they purchase and they invest in, it's above 20%. Anything above 20% is good. So obviously you see here we have everything above 20% except for in 2017, which I'm not too sure about. Something happened in 2017 to have these reflections in number where it stands out tremendously from the years ahead of us, which is the 2018, 19, and 20 and the trailing 12 months. So you can see that something went wrong. I don't know what happened in 2017. We didn't dig that deep, so I'm just going to go over what I have as of today. And of course, all this information has been gathered from Yahoo Finance. These are the numbers that I gathered from here with the EPS and the dividend yields and the analysis and the financial statements. Here is the income statement, balance sheet, and cash flow. All that information I populated here. The income statement looks pretty good. We're in a good start right now. In regards to the balance sheet, we have return on equity, meaning everything that they have, whatever they're investing in so far, and what is that return for them. So that return for them right now is each year so far has been below the 20% threshold that we have set. Anything above 15%, it's getting there, meaning it's not bad, it's not horrible, and that's why I highlighted it in yellow. Okay, the 15 to up to 20, and then if it was to be in the 20, it would have been a green as well. So now you can see what these numbers mean as well. And of course, this spreadsheet I can always share it with you guys. If you're interested, please comment, like, and subscribe to this channel so I can keep on producing videos similar to this if you're interested. And of course, I have other types of videos in regards to finance and building future wealth. Let me continue here. Average overall, we are looking with the years combined, it's at 11.3%. Not the greatest. Of course, all these are red. Not one of them is efficient. Okay, so that's the balance sheet. Now the cash flow, we have to kind of give it some props here, because in 2020, 2019, and 2018, again, 2017, something happened here where I said that, you know, every year, every income statement, balance sheet, and cash flow in 2017 has reflected something that might have drastically changed, or they had more debt, or they borrowed money, whatever the case is, or they lost money, because you can see their gross profit and revenue and the net income for 2017 was extremely low in comparison to the other years after that. I'm not sure what it is. Okay, so now we're just looking at numbers. We're looking at numbers and we're basing it off of, so what I have in cash flow is saying that the lower the percentage, the better. So the capital expenditure divided by their net income, and we get these percentages. Now, 3.55% is really close to zero. Now, I'm going to say close to zero. It's not zero, but it's closer to zero than 7.2 and obviously 56.78. So the lower the number here is better. And their dividend payback for the last 4 years is here as well. These are in dollar amounts. So 316 million, so on and so forth. It has been increasing each year. So that's a good sign. They have been efficiently paying that back. So this is the intrinsic value formula that I have, and again, the blue cells are fixed values Ben Graham had used to analyze intrinsic value of a stock. AAA bond yield is as of today, which is 3.06. So the intrinsic value comes out to $151.02. Now the current price is $92.17. So that puts it into a buy. The upside is 63.85. That again is the dividend and the yield. And one of the reasons why it's coming up probably a buy is because it's anticipated its next 5-year growth rate to be 17.83, which is pretty good. And we can take in consideration what it was the previous 5 years. And the previous 5-year was 11.89. They are expecting next year to be 17%. With the chart, in regards to the chart itself, you can see that just like a lot of other things that I analyzed so far, and of course this is just my opinion, don't take everything I say as gold, don't go out and rush and put down a lot of money into these positions. I'm just evaluating the stock because you can see it has been trending for the longest time. You can see, imagine buying back in 94, 93, it's below $1 and slowly but surely goes up, but then everything in 2018 always just shoots up. It's a possibility during the election, there, just a couple things that may have contributed to it. And you can see it had a dramatic drop in 2019, and then even in 2020 with when we had the whole lockdown, wasn't that bad. It's still at the highest. As of today, we are looking at the highest of the high for Blizzard, meaning it hasn't dipped below the highest. It's creating new highs as I'm speaking. They are evaluating Blizzard as a fair value right here. It is a long-term stock, does pay a dividend, but their PE ratio is a little high, but that also depends on how much you're willing to pay to get into position with Activision. Other thing that is in the news today, which was a little more interesting, was today Activision news is, we'll look right here, Activision Blizzard names a new CFO, and this was just literally 15 hours ago. Activision Blizzard hires former Trump administration official. A lot of news circulating around Blizzard today, new CFO, they're hiring former Trump administration individuals. I will link all these articles in my description. I did go through, I read some of them. Does it affect the actual purchases of the stock? Unless you're like in a very political stance where you're choosing companies based on who's working there, possibly, okay? I can't say for everyone, but I've never done it because I don't know anyone that works at any corporation to that extreme, what their political stance is, right? It's just interesting that they had to point that out, that hires a former Trump administration official. Now, one thing to note with Activision, another thing that I did read today was that they are relocating their facilities, that I believe the 10-year lease is up. So that's one thing. They are staying in, I believe it was San Jose. So let's see, Activision moving. Right? It's reported moving offices. So that's what I read. This was 4 days ago. No longer be based in their long time offices as on Ocean Park Boulevard in Santa Monica, California. Its California employees have reportedly been told to work from home until further notice. Pretty cool. At least they get to work from home, right? Founded in July 2008 through a merger of Activision and Venvetti Games, Activision Blizzard signed a 10-year lease for both buildings back in 2010. The company has decided with the expiration of the lease to move elsewhere. So no word on where they're moving to. That's going to probably come up one of these days. I don't know how much that would affect the stock. But because their lease is up, unless they find something cheaper, they will need to dig into their net profits to probably pay the new rent or new renovation. So money is going to have to come out and do these things, right? No office is going to be perfect where they don't have to renovate. Renovation has a cost to it, and that is going to cost the company some money. Now, whether that drives the stock up or down, that's very skeptical. I'm not sure. I don't know how to take that, but you will start seeing if they move and they find a new office, or they just may stay working from home for another year, and the profits that they make, they retain that. They save up enough and then find a place and then renovate it. That's when you probably start seeing within the following year that their cash flow or debt may increase a little bit. Okay, so that's just my take on it. Also in the news for Activision Blizzard was that they did lay off, I believe they said 3% of their staff. Here is is a local Blizzard investor upset over CEO payout amid layoffs. So obviously there's always this whole CEO getting paid too much and laying off people. They had laid off, this is as of March 16, 2021, they had laid off 50 employees that were involved with live events. After that, revealed until that laid off employees have received $200 gift cards for the company's Battle.net store. Against all this turmoil, CEO of the company is set to benefit from the loophole that will see him given almost $200 million. Oh my goodness. That's a lot of money. I don't know. But the positive thing is that, see, Activision right now is in a net cash positive, meaning they have, even though they have debt, they have enough assets and to offset that. So they are in the positive. And of course, here you can see if you type in Activision debt, Activision Blizzard has a debt of $3.33 billion, up from $2.67 in 1 year, but it also has a $7.6 billion cash to offset that, meaning it has US $4.27 billion net cash. So they are in a net positive, and that's a good thing. But they are laying off people. They did get a new CFO, and they do have some very controversial articles in regards to the CEO and the staff. So very, very hard to judge what the company may turn, direction it may turn, even though number-wise, it's considered a decent investment. And it's also saying that it's a good buy for long term. There are news surrounding, and news always affects a company really, really dramatic, right? To be really cautious of that, because the gaming industry has always been, to me, in my opinion, very lucrative. But at the same time, it's so dynamic, meaning one game could be popular and another game just comes over and takes over the whole scene, and you won't even bother with the old stuff. It gets dated really fast. And I think one of the reasons for that is because kids, teens, adults, their attention span, including myself, is that once I play a game, I'm not playing that game for life. I mean, I play it for a while. There may be a replay value to it, but they die down. World of Warcraft was the hottest thing at one point, but you really don't hear much of it. Maybe there's still some players left, but not at the same rate as what it was at its prime. So you have to take those into consideration. So they the gaming industry has to constantly keep up to date with these things. Very, very competitive. A lot of games out there, a lot of different game makers. Those things are very much, you have to take those into factors as well. But right now, Activision is a buy. They do have good lines of games. And I did a search for Activision games. Their Call of Duty line is very, very good. They have a lot of classic historic games. They also have, they have Crash Bandicoot, Skylanders. So these are popular games. They had Tony Hawk back in the day. I believe that had expired because I actually followed Tony Hawk as well. So there's a lot of decent games here. But again, if I had to say one of the most recognizable game, obviously, is Call of Duty. Anything outside of that is very, very hard to say Activision is known for other games. Historically, it had a lot of great games as well. It had Warcraft. It had Activision Blizzard. Okay, Blizzard had Warcraft and World of Warcraft and Frozen Throne, StarCraft. There may still be a population or percentage of people that still play that, but it's not one of the latest and hottest trends of 2021. A lot of things into consideration, but the stock itself, number wise, it's okay. Now, personally, would I invest in Activision Blizzard? Yes, but not a hell of a whole lot. The dividend is not that great. I would probably put that into my dividends portfolio, but it probably wouldn't be much, and I wouldn't expect much of it. Now, the stock price itself, would it be considered something? It's not cheapest for the dividend that it's paying back. So you really have to anticipate the company doing really well and pushing out new games, whether it's every year or whenever it is. They really have to be on top of the game in order to have a decent, return on the stock and the dividend. So I would consider it, but it's probably wouldn't be my first choice. Again, that is just my opinion. I want to thank you guys for being here again, going through Activision Blizzard. I appreciate it. See you guys again soon. Bye.